Hi everyone, in this video we'll be beginning with chapter number 35 of CMT level 2, the statistics of backtesting. So as we all know, backtesting is one of the most important concepts or important things which you need to be doing when you are creating a trading strategy. Creating a trading strategy or getting a trading strategy from a person is one thing, but the second thing and the most important thing before you actually put in your real money and before you actually start trading in your live account is to backtest it. Backtesting basically means that you are seeing the historical charts and you are applying your strategy on the historical charts, and you are seeing how much of percentage return it has given you in the past and how it is working in the past. That will give you a sort of even confidence that in the future also it will work according to what it did in the last week. So it is important for you to know what do you say, it is important for you to know what the win rate is of your strategy. So we'll be learning about the statistical challenges which are faced when we are backtesting, analyze four important statistical features of time series price data, illustrate why log returns are often used in backtesting, analyze three statistical concerns in backtesting, differentiate between signal testing and backtesting. Introduction. Because technical analysis lends itself well to concrete trading rules, technicians were some of the first investors to turn their subjective strategies into trading systems. That also made technical traders among the first to utilize backtesting on a large scale. Chances are you have at least some passing familiarity with the concepts behind backtesting at this point. So I'm also assuming that you guys know what backtesting is. What you may not yet have been exposed to are the statistical factors that need to be considered when conducting backtests. The purpose of this section is not to provide a primer on backtesting, rather, the goal is to identify some common problems that lead to unreliable backtest results as well as some solutions. Backtesting is simply a simulation of how a trading strategy might have performed in the past using historical market data. Note that might is an operative word in the definition. Try as we might to make a backtest as realistic as possible. Backtests tend to be a poor substitute for actually being in the market in the real time. So obviously, right, just because something has worked in the past, that cannot be 100% true that it will work in the future as well, right? Even though that is all the data we have and we need to use a strategy which has worked in the past, but that doesn't guarantee anything, and you need to always keep that in mind that no strategy works 100% of the times. Such as the fact that you do not have to worry about losing sleep while your strategy is in drawdown during a backtest, while the same pain may be too unbearable to remain systematic in reality. When you are just backtesting, you are changing charts, you are taking losses, profits. It's that simple. But when you're actually in the trade in real time, a lot of fear and a lot of emotions come into play, which is not basically accounted for during the backtesting. But the statistical factors of a backtest are often under-considered. It is not hard to understand why this is the case. The assumptions made by statistics often make backtest results look more favorable than they should. Investors rarely relish seeking out new ways to find flaws in their work. With that in mind, understanding the statistical realities of backtesting is critical because it can help you avoid the pitfalls of false discoveries and the losses that follow. As the old saying goes, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. Taking a valid statistical approach to backtesting helps to ensure that the trading systems you develop yourself or evaluate for others continue to work during live trading. Before we get into the practical and statistical considerations of backtesting, it makes sense first to take a closer look at some of the statistical characteristics. Okay, talking about the statistics of time series price data. Sometimes I feel like we are often confused with what exactly is time series. So let's see what the Google defines it as. Time series is basically a series of data points indexed or listed or graphed in time order. So time series is basically this, right? The reason why I showed you the Wikipedia definition is to make things simpler for you. So it's just basically the charts which we see because they're plotted according to time, right? Okay. It has been said that conquering the financial markets is the last great intellectual challenge left for the market mankind. That is due in no small part to the fact that, from a statistical standpoint, price data is the stuff of nightmares. Data scientists in other domains often have the luxury of compliant data that exhibits nice statistical properties, not so for the investor. But by understanding the statistics of price data, we can work within the confines of tools available to us and avoid making incorrect assumptions about what the data are telling us. Talking about non normality of returns. What is non normality of returns? It has been shown repeatedly in academic research that price returns do not follow normal distribution. For example, okay, let me just highlight it if you are looking to note down the lines which are the most important. So, price returns do not follow normal distributions. For example, under a normal distribution, we expect that observations will only exceed two standard deviations above or below the mean 5% of the time. However, when we talk about 2008, the daily returns of S&P 500 exceeded this threshold by almost a factor of 3. This is problematic because many statistics and statistical methods, such as properties of linear regression, have a normality assumption in their interpretation. Likewise, many academic models have some assumption of normally distributed returns banked in. So, the first and important thing which you need to keep in mind is the non normality of returns. Even though that's how it is assumed and that is how it's supposed to be, it's not possible 100% of the time. So the second thing is path dependence and serial correlation. Now, what is path dependence and serial correlation? So, the first thing you need to keep in mind is that the price data, exhibits high levels of serial correlation. Okay, and what is serial correlation? Let's also look at that. We have done this in the earlier chapters. Try to think about it. Serial correlation is also known as autocorrelation, and that's what we read in the statistics chapter or the chapter which was on correlation, right? So that is basically serial correlation or autocorrelation, which means how one particular thing is related to itself over a period of time, right? So when I say autocorrelation of gold, which means that I am seeing the relationship between gold prices of today and the gold prices of few days earlier, which means I'm seeing the relationship between the same instrument over a period of time. So that is what is known as autocorrelation. Okay, so yeah, one sec. This is also deeply tied to the non-normality of returns. Another consideration loosely tied to serial correlation is path dependency. Price moves often have some reliance on what has happened in the past. The occurrence of some event may drive price behavior in a way that meaningfully differs from the way that stock acted before the event. So, the fund manager who blows up his account may not be around to take the next trade that would have pulled his fund into a positive territory. So, this is one main thing, right? So path dependency basically means that what has happened in the past, it is going to be reliant, right? It can be reliant on it. So if you've blown your account in that kind of a situation, then there's tough for you to be back into the market to take another trade. So which is why, again, we always say that risk management is extremely important, so that in such situations also you stay in the market even after taking a stop loss or booking a loss. You need to be able to have money so that you can take a trade which is path dependent. So we saw what is path dependence, and we also saw what is serial correlation. Now let's talk about heteroscedasticity. Now heteroscedasticity also we saw in the statistics chapters, right? So price returns are usually heteroscedastic, which is in this context means that their variance changes over time. So we know that the variance keeps changing over time, right? Especially across long time frames and market regime changes. Again, this poses a problem for litany of statistical um, tools that assume stationary variance. So if you assume that the variance is going to always stay as it is and it's always going to be stable, then you will be wrong, right? Because price returns are usually heteroscedastic. Heteroscedasticity is very problematic when using descriptive statistics based on variance, such as standard deviations, to describe risk. Because the risk measure is changing, an investor may find that their risk exposures could have drifted materially from the time risk was last measured and their portfolio constructed. Again, if you want to see the if you want to see what Wikipedia says, it means that heteroscedasticity happens when the standard deviations or variations of a predicted variable monitored over different values of an independent variable are non-constant. So they are not stable. They keep changing and they keep changing values basically. So that is heteroscedasticity. Then we have self-correcting. Now, what is self-correcting? Self-correcting is basically exploitable market opportunities are also self-correcting. The mere act of buying or selling a stock impacts its price. Similarly, any exploitable buying opportunities made public should lead to other market participants wanting to buy shares first, narrowing the opportunity for others. In many ways, this makes gaining an understanding of price action like hitting a moving target. So, self correcting, everything is self correcting, right? Buying and selling, everything basically impacts the market. And buying opportunity that is made public, if then people are going to, like, let's say a particular very big investor makes it public that he's buying something, then that is obviously going to impact the sort of demand which is there in the market. So, we saw what path dependence and serial correlation is, and we also saw what heteroscedasticity is. That means that the standard deviation or the variance changes over time, and we saw what self-correcting is. Now let's talk about solving the issues with price data. Luckily, dealing with price data is not a lost cause. While it would be impossible to cover every possible situation to the statistical challenges presented by time series price data, we will briefly describe some of the most important approaches that may be useful. So the first important thing is the log returns. Now, log returns is something which will be for sure tested in your exam. So, you need to be aware of what this concept really is. A little bit about log returns we saw in the statistics chapters. One common way of handling many of the statistical challenges of dealing with price data is to take the logarithm of the price returns instead of using the raw price returns. This is particularly common in academia where log returns are almost always used in published papers. So, log returns can be calculated with the following equation: log 1 plus ri, one sec, yeah, ri. So, ri is basically the arithmetic return at the time period I. So, whenever you see I, it is basically the time period. You need to keep that in mind. Give me a second. It may seem counterproductive for a technical analyst to push raw price data through a mathematical transformation like this, but in fact, it is far from new territory. Technicians have been using logarithmic scales on price charts for most of the last century. In fact, log scales are often the default option on most charting packages. In fact, even when you go on TradingView, I'm really not sure where I saw it, but I do remember seeing somewhere over here where we had a logarithmic chart or some indicator which showed us the log indicator. Yeah, see, we have a lot of logarithmic related indicators as well because a lot of people use log data instead of raw data. Okay. In fact, log scales are often the default option on most charting packages. One benefit of using log returns that is related to log scale chart is time additivity. So, the biggest advantage when it comes to using log data is basically the time additivity. Unlike with simple returns, the sum of n periods log return is equal to n period log return. This is not the case with simple arithmetic return. Put another way, log returns automatically handle compounding. At the same time, for returns less than 100%, they approximately identical to simple returns. Another key, okay, so I hope you understood this. There's nothing to describe over here, right? So sum of the periods n is taken in the case of simple returns, right? And when you talk about log returns, they automatically take the compounding into account. So you don't have to do the compounding separately. So that is what is known as time additivity. Then we have distribution. Now, what is distribution? While, okay, I'll highlight this also. While we have established that price returns um, do not follow normal distributions, there is some evidence that some market returns approximate log normal distributions. By log transforming returns, we are able to use parametric statistical methods that make this normality assumption. One important caveat of about log returns is that unlike simple returns, the weighted average of the individual security in a portfolio does not equal the portfolio's return. Likewise, there are several other mathematical artifacts involving log returns to consider if you plan on relying on them. Okay, so I don't know if you understood what distribution is. So I'll just quickly explain it again to you guys. So you know one thing. We saw the non-normality, right? We saw that normal distributions are not being followed, right? So you also need to know that there is some evidence that some market returns approximate log normal distribution. By log transforming distribution returns, we are able to use parametric statistical methods that make the normality assumption. And you know what parametric is? We saw that also in the other chapter. So we saw what time additivity is, and we also saw what distribution is. Okay, let's talk about other normality cures. Sorry, what is other normality cures? Besides using log returns, okay, let's just quickly revise the log formula. Log, okay, I'll use a better pen. So, how do you calculate log returns? You calculate log returns, new returns, which by log 1 plus Ri, where I is the time period and R is the arithmetic return. Log 1 plus R. I is the time period and R is the return. Okay. Besides using log returns, there are other approaches to dealing with the non-normality of price returns. Fully understanding your data is key. It is entirely possible that some systematic trading strategies will naturally produce trading returns that approximate a normal distribution, getting you close enough that you can use conventional tools to evaluate your strategy's statistics. In other cases, different types of mathematical transformations may be more effective at approximating a normal distribution. It has been observed by past researchers that taking price data out of time series and instead building bars from a more market oriented mechanism such as volume or dollar volume can make price more closely follow a normal distribution. So what they're trying to say is that instead of just taking out data from time series, if you build bars from more market oriented mechanisms such as, let's say, from taking from the dollar volume or volume, then usually price follows the normal distribution, while in the other case, you know that non-normality is a very important characteristic of the data. So for that reason, you can see more market oriented mechanisms such as the volume or dollar volume. This is an approach that should be familiar to technicians. Like, for example, we saw about the point and figure charts. So after all, charting techniques does not rely on time, which is why we saw what was different about the point and figure chart and the range charts is that they do not change according to time. In fact, they change according to certain values. Another solution to this issue of non-normality of returns is simply not to use the ubiquitous normal distribution. Researchers have shown that some time series asset price returns actually approximate a Pareto distribution, specifying that in place of a normal distribution may yield better results. Some people use Pareto distribution instead of normal distribution. Finally, one of the most effective ways to get around normality assumptions for distributions is to not make any assumptions about the underlying distribution of price data at all. Non-parametric methods can allow you to perform statistical tests based on the empirical underlying distribution without needing to know what it actually looks like. Now let's talk about a very interesting concept, that is what we know what backtesting is, right? Like at least we assume that we know what backtesting is. But what backtesting is not. So before we get to what backtesting is, we should discuss what backtesting is not. Often the very first thing an aspiring systematic trader will do is enter some basic trading rules into backtesting software and test those rules over some historical time frame in order to see how much money they have made. That is a little like a pharmaceutical researcher heading down to the lab and grabbing a pinch of this and dash of that, putting into the pill press and giving the result concoction to a patient to see if they have formulated the cure for a rare disease. It combines many research steps into one and completely obfuscates what is really happening. In other words, it is not a scientific process, but it should be. The backtest is actually the final step in the system development process. The signal research must happen first. Okay, so you can't just directly load everything into the system and just see how much percentage you've made. You're supposed to make everything on a step by step basis, right? So part of this reason, that's why they have talked about signal testing first. Part of the reason this rule is violated so often is the word backtest is so often thrown around with reckless abandon. Even unsophisticated investors want to know whether a backtest has been done before investing in a new system based strategy. As a result, nearly any analysis of historical data is often called a backtest. Likewise, many commercial backtesting tools are designed in such a way that signal definition, rule creation, management, all of it happens on the same screen, right? Like any of these backtesting softwares we use, you can see that all of them are basically done on the same screen. So you think that that is the best way to do a backtesting, right? Like just loading all of the information into the screen and seeing what percentage you've made. But that's not really the ideal method to do backtesting. It is important to differentiate between backtesting and signal testing. The latter, which is the signal testing, is a research tool, while the former or backtesting is a validation tool. Signal testing focuses on putting the statistical inference tools introduced to work in order to identify important causal and predictive relationships. A signal is an event that is predictive of future prices. A strategy, on the other hand, actually puts one or more signals to work with trading rules. Often, the deliverable in signal testing is a hypothesis test. If a signal is determined to be predictive of future price returns, then the strategy moves on to the next phase. Otherwise, the research process starts anew. By separating signal testing from strategy backtesting, a technical analyst avoids combining two distinct elements of system development into one unmanageable meta step. Besides better interpretability, this also avoids some major statistical issues down the road. Separating signal testing from backtesting does not merely mean separating the steps. Where possible, signal validation should happen with completely segregated data from the data used in your backtest. The reason for this is that backtesting a signal on the very same data that is justified that signal is akin to running the same test again. It certainly should look favorable. This is a less obvious example of. Now let's talk about what are the concerns, statistical concerns in backtesting. There is no shortage of pitfalls when it comes to backtesting. In the CMT program, you will learn about all manner of biases and errors that may render a backtest result invalid. Concepts like survivorship bias and not including trading costs are well known. In this section, we are only concerned with lesser known statistical considerations. When it comes to the statistical concerns of backtesting, there are three major potential pitfalls that are both not widely known by investors that can destroy the effectiveness of backtest. Multiple testing policy, trading system complexity, and meta look ahead bias. So you know that some things, for example, just if you're risking $250 in one trade, and if you win, you're making $750, but if you lose, you're losing $250. And in your backtest, you are just taking plus 750 minus 250 in case of a stop loss, in case of a target plus 750, and you're doing the backtest. But the truth is, you are paying transaction fees or a brokerage fees as well. So you need to account to that and you need to add that to get the actual amount which you are going to make. Talking about multiple testing policy, imagine that your fund is evaluating a large database of investment strategies to find one that generates true excess returns. In order to ensure the highest level of rigor for your investors, you have decided to run a hypothesis test to verify that the excess returns are statistically greater than zero. After learning about the base rate policy, you decide to use a significance level of 0.01. You decide to randomly test 150 of the strategies in the database. Great news, you have succeeded in identifying a trading strategy that yields statistically significant alpha. There is one problem. All those separate tests you did, when you conducted your first hypothesis test in the first strategy, the significance level you set meant that there was just 1% positive. Okay, why are we saying 1% probability? Because the significance level which we chose was 0.01. So we are basically saying that there was just 1% probability of seeing a significant result due to chance alone. But by adding that second test, the probability of getting a randomly good result shoots higher. Now it's at 1.99. But you tested 150 separate strategies. What's the probability of getting statistically significant result due to randomness when a total of 150 tests are conducted? It turns out to be about 78%. Suddenly, you are more likely than not to have found a false positive due to the sheer number of tests you performed. The mistake is known as multiple testing fallacy, okay, and sometimes called the multiple testing comparisons problem or data dredging bias. It has been cited by professors, okay, likely false, including put into production of an active strategy by an investment manager, likely false. The issue is nothing new. It has been documented since the 1950s. And while the dangers of multiple testing have been well known in disciplines with major parallels to backtesting, such as machine learning, for quite some time, systematic investors are like beginning to become aware of it. Thanks to the efforts of researchers like Lopez de Prado, Harvey, and Liu. Note that multiple testing is similar to the idea of mining bias as well as look elsewhere effect. The solution to this multiple testing fallacy actually begins with experimental design. Trading system developers should start their process with a well thought out plan of attack for how to handle their data to avoid leakage between signal testing and back testing. Likewise, they should keep close track of tests performed to build a strategy. Consider treating trials like a finite currency that should be closely monitored rather than another pull of the slot machine, right? So obviously, just because we know that back testing means that real money is not going away, so you can keep loading in money and you can do all of that stuff, but you realistically cannot be doing that even in back testing because you will not be doing that with your real money, right? So the common practice of informally coming up with trading rules and playing with a back testing tool to see how they work is antithetical to the scientific approach needed to succeed in live trading, systematic trading. By tracking the number of independent trials you conduct, you can adjust your goalpost for what is considered significant either in your significance level or in your backtest statistics. For significance testing, such as during the signal testing phase of strategy development, the simplest adjustment to make a significance level is the Bonferroni correction, which takes the original significance level and divides by the number of tests. So, in that case, what was our original significant level? It was 0.01. And how many tests we took? We took 150 tests, 150 strategies into account. So when I divide 0.01, the significance level, divided by the number of strategies of 150, you get 0.000067. So that is the Bonferroni, that is called the Bonferroni correction. While the Bonferroni correction is considered too conservative in many fields, that higher bar to significance may actually be appropriate for investment backtesting. Likewise, there are other alternatives available. For backtest performance result, one way to account for multiple testing is the deflated Sharpe ratio or the DSR. So it is given by Bailey and Lopez de Prado, DSR. So if the question is what is DSR and it's given by whom, you should know that DSR is deflated Sharpe ratio and it is given by Bailey and Lopez de Prado. The deflated Sharpe ratio measures risk adjusted return while correcting for multiple testing and non normal returns of distribution. Now we know what non normality is, right? So you need to keep in mind that we saw two things. The first thing we saw was non normality, and we also saw what is multiple, um, what was it called again? Multiple testing fallacy, right? Yeah, multiple testing fallacy. I keep getting confused with this name. So, deflated Sharpe ratio basically helps and takes into account two of the most important and two of the most biggest challenges which we have. The first thing is the non-normality of the distribution, and the second thing is basically the multiple testing fallacy. So, Sharpe ratio, the deflated Sharpe ratio given by Bailey, basically helps us to avoid these two things. Trading system complexity and the bias variance trade off. Now, let's talk about this. The hyper competitive landscape of the investment world has made complicated and obfuscation an art form. Traders try to cobble together the most sophisticated systems conceivable in order to gain an edge. At the same time, it has long been an investment aphorism that the best trading systems are often simplest. Is there a statistical answer to the question of a system complexity? It turns out that we can get some guidance from another concept that comes from the world of machine learning, the bias variance trade off. It should not come as much of a surprise that parallels between machine learning and backtesting run deep. Both involve taking prior data and attempting to generalize a model that will work on data we are yet to see. Systematic trading is increasingly done using machine learning, and a lot of AIs are also there which do the um, systematic trading, right, which is also known as the bot trading nowadays. Bias and variance are two major sources of controllable error for machine learning models. In simple terms, bias is error due to a model that is too simple to capture the true function of the data set you are trying to model, while variance is error due to the model being so complex and specific to the historical data that it cannot generalize to unseen data. So, bias is error when the model is very simple, and variance is error because the data is very complex. Okay, it is not hard to imagine how these concepts might translate to strategy development. For instance, the simplest trading system is buy and hold. It does nothing. While the strategy will capture returns, it will also miss out on trading opportunities and potentially expose the holder to significant drawdowns. This is a biased strategy because it is simple, because it doesn't model the optimal trading strategy for the market. It is underfit. On the other hand, an extremely sophisticated spline model might do a stellar job of capturing turning points, but it will be so overfit, right? Because it is difficult and because it is complex, it will be overfit and it will not generalize. This is high variance strategy because changing the training data completely changes the model which we get. The total error of any model and suboptimal returns from any backtest follow a U shape as the complexity of the model is increased. The simplest models have no variance. They do not change when the training data changes, but they have substantial bias. Likewise, extremely complex models have no bias. They're able to perfectly model market turning points, but they will be so overfit to the randomness in the price action that the model doesn't work on any other time frames. The goal of the systematic trader is to find a strategy that is complex enough to capture lots of profits without becoming so complex that it becomes overfit. So there should be some sort of a balance in it. This is the statistical basis for the old advice that trading strategy should be as simple as possible. Einstein is credited with saying that everything should be made as simple as possible, but not simpler. That turns out to be one sec. What is it? That turns out to be apt advice for trading strategy development. Systems should be made as simple as possible to avoid the risks of overfitting, but not so simple that they fail to capture the moves of the market. Likewise, another implication of the bias variance trade off applies to backtesting is that well documented techniques for model selection and minimizing multiple testing problems can also be applied to investment system backtesting to achieve an effective system without overfitting. For instance, techniques like cross validation can be useful for strategy selection and parameter optimization on finite data sets while keeping the bias variance trade off in check. Let's talk about meta look ahead bias. What is meta look ahead bias? A final under acknowledged source of errors in backtest is what we will call meta look ahead bias. Traditional look ahead bias is a well known issue that can greatly overstate backtest returns. It occurs when the strategy has access to data that it would not have been able to see at the time of the historical trade. For instance, a fundamental strategy that gets input from quarterly fillings as of the quarter end could show much larger returns in its backtest than in practice because it effectively has access to non-public information. A subtler example is a technical strategy that calculates its buy signal based on closing prices and buys on the day the signal triggers because the signal is only calculated after the close. It would be impossible to actually execute the trade during that session. While look ahead bias can into sneak its way into otherwise well thought out systems, it is not hard to spot when it actually sought out. More challenging to spot is meta look ahead bias when it comes from the trader's own pre existing knowledge of the data state. Present any trading system to a potential investor today, and very frequently first question they will ask is how did it perform in 2008. The extent to which 2008 was a remarkably bad year for investors makes it top of the mind when evaluating trading strategies. It's a human nature. And likewise, the mere knowledge of a major trading event can influence trading strategy development. Often, when an aspiring systematic trader decides to create a new trading system, they will consciously try to think of an approach that would skirt the painful drawdown of 2008. So, you would want that your strategy basically even worked during the historical crashes. That is a bit like building a machine that predicts last month's lottery numbers. The results will look impressive in practice, but they will be useless at predicting what will happen next. Meta look ahead bias is a problem specific to financial market research. In many other fields, data sets are often relatively unknown until they arrive on a researcher's hard drive. Not so in the investment world, where we interact with markets in real time and asset relationships are deeply intertwined. A technical analyst may spend her entire career looking at an updated versions of exact same data set, leaving large potential to overfit to her historical pain points. The solution to meta look-ahead bias isn't far off from the solution to the multiple testing policy. Good experimental design and conscious effort to avoid it. Alright, so that is our meta look-ahead bias. And again, for better understanding, you can also read what is meta look-ahead bias. Is when data was not readily available at the time is used as a simulation of that time period. Meta analysis, comparing the available data. So that's it with this chapter. We are done with this chapter.